All week long, we've been also talking about the Biden administration's report on stablecoins, which recommends federal agencies regulate issuers as banks. Stablecoins are, of course, the foundation of the crypto industry, allowing investors to trade in and out of positions. If the crypto industry were a casino, stablecoins would be the poker chips. Joining us now to discuss is Jeremy Allaire, CEO of Circle, the stablecoin issuer of USDC, the 10th largest cryptocurrency with a market cap of over $33 billion. Hello there, Jeremy. Good to have you on the show. So how does this report affect Circle and USDC?
Yeah, there are a number of pieces in this. I mean, I think the first is essentially a lot of observations about what could happen if stablecoins became much, much larger and used for everyday payments in the economy, impacting the real economy and the financial system as a whole. So some of it is just sort of describing, a world potentially in the coming years that the administration clearly sees is possible, if not likely, and wants to get out ahead of it. Hence, the very strong kind of urgent plea, in a sense, the urgency with which they've asked Congress to take this up and to work on new statutes, which really leads to, I think, the second piece, which gets to the heart of the question, which is what the Biden administration, and in particular, the heads of the Federal Reserve, the U.S. Treasury Department, the FDIC have done is they've said stablecoin issuing and the overall arrangement of how stablecoin works on public blockchains, with wallets, with exchanges, this whole kind of ecosystem that we all kind of take for granted here in crypto land, that they don't feel that they have the statutory authority to regulate stablecoin issuers, at least under banking law. And so what they're proposing is that Congress essentially develop statutes around issuers like Circle becoming Federal Reserve, banks overseen by the Federal Reserve, insured depository institutions that would give confidence to not just the stablecoin users, but financial market participants, and then ultimately the financial system itself, that these are durable, reliable, fundamental market infrastructure for the real world economy. So first, I think it's very encouraging overall. Second, in terms of directly on Circle, as you may know, we have already announced that we are in the process of submitting an application to become a national Fed-supervised, FDIC-insured digital currency bank. And so I think this very much is aligned with our view as to how something like USDC ought to be regulated in the U.S. financial system.
Jeremy, was there anything about this report that was surprising or unexpected, or was this pretty much what you thought was going to happen?
So I think for the most part, it's what we expected. I think, like a lot of these, this is a set of recommendations. It's a sort of an analysis and a set of recommendations. It's not law. This isn't, now there's this and you have to do it. And so within that set of recommendations, there were things that I think the spirit of them were understandable, but sort of the way that they're presented, I think, pose some real significant challenges. So I think one of the deepest ones, and I've commented on this on Twitter, is, financial market infrastructure has historically been something that is very, very tightly controlled, literally physically controlled, under very, very tight control by private entities and or public entities or some combination therein. And we're building a world where market infrastructure, in fact, not just market infrastructure, sort of the base layer of economic activity on the internet, is actually a public good. It exists as public infrastructure, i.e. public blockchains. And we're all building on top of that. And we're building apps like USDC. We're building apps like games. We're building apps like social media. We're building a lot of things on top of that, Web3, et cetera. So the recommendations sort of assume that that's not possible, basically. Like, well, they have this idea of you're going to regulate all of the entities under some federal guidelines and Fed, risk management. But you can't regulate a public blockchain. It's sort of like saying you're going to regulate, internet email or HTTP, the protocol of the web. Like, these are just open networks that everyone can connect to and participate in. And so I think that my comment here is really that the devil really is in the details. If Congress does take this up and say, how are we going to, look at this as a new pillar for the financial system? Well, it also means understanding that we're building on, public blockchains. That's a huge, piece of this.
So, Jeremy, who do you want to regulate you? We had Warren Davidson on, Representative Warren Davidson on a couple of days ago, and it sounds as if for him the ideal world would be different agencies would potentially regulate stablecoins depending on their asset base. But who do you think should regulate USDC? Who do you think should regulate stablecoins in general?
Well, so two pieces to my answer. The first is we are already well regulated. And we are regulated within the fintech laboratories that have regulated PayPal, Square, Stripe, Apple Cash, Venmo, so many other products and services that we all take advantage of and use. So we're regulated under banking supervision throughout the United States with very strong AML, consumer protection, full reserve requirements, a whole number of things, electronic stored value, money transmission, right? So we're regulated today with there. Our view has been, and I think this, to more firmly answer your question, has been that as something like a dollar stablecoin like USDC becomes very large, hundreds of billions in circulation, trillions and trillions of transactions in value, and it's something that financial institutions and others are building on, it really belongs at the federal level. And so we believe it should be, the Federal Reserve, the U.S. Treasury, OCC, and if appropriate, if there is an insurance model on it, the FDIC as well. So that's been our view, so I think that seems to be the direction of travel here in the United States.
So Jeremy, you've changed a bit of how your assets are allocated over the past few months, and one criticism that persists, though, is that your short-term accounts, the under 90-day portion of your assets, are still potentially in commercial paper, and you haven't broken that out yet. Why don't you break it out? Why don't we see what part of your short-term assets are in commercial paper versus U.S. Treasuries, and also how those commercial paper are rated, where they are? Are they in the U.S. or are they Yankee bonds? And as well, do you use any crypto at all as potential collateral, as potential anything in your business?
Well, so for us to use crypto collateral to issue USDC would be illegal in money transmission rules. So absolutely not. We've never, ever done anything like that. So we report out as cash and cash equivalents, which is a generally accepted accounting principle. It's very well understood as well. What we have publicly said is that it's cash and short duration U.S. government treasuries, which is what that is. We list that as cash and cash equivalents, which is understood, but within the financial industry, I think fairly well. So I mean, that's the straightforward answer on that.
But why not give a little bit more detail on that? Since this is such a contentious issue in the stablecoin world,
I think financial institutions, corporations, et cetera, that list cash and cash equivalents don't break all of those things out. I mean, I think that'll be an interesting regulatory question whether we think that's necessary.
But it wouldn't it help to at least volunteer it? I mean, it is such a problem in this industry, and it's a growing industry, and it's clearly a worry for federal regulators. Wouldn't you want to at least show some?
We depend on our regulators to tell us what we ought to do there. So, for example, the state banking supervisors that supervise us, and what we are allowed, what a cash equivalent is in that determination, we depend on those regulators. So I think what you're suggesting is that there should be a greater level of self-regulatory kind of activity here beyond what we've done, which is also above and beyond what we're required to do from a regulatory perspective. No one's asking Dan Schulman, break down the $35 billion reserves. No one's asking, Tim Cook, break down the reserves behind Apple Pay Cash. No one's asking Cash and Jack Dorsey to do that. So I think we just have to figure out, are we going to depend on a regulatory framework that has a very well-defined framework of accountability and law, or is this, a kind of, a desire to sort of establish something outside of the regulatory framework that we have?